All right, guys, welcome to our very first episode of Whiskey with an Agent, Dram Style.
Dram Style.
Dram Styles. Dram Styles are going to be shorter versions of our long form, our live shows that we do on Facebook and YouTube. Those are typically an hour and a half to 2 hours. These are about 15 to 20 minutes long. And today we're going to be talking about interest rates. My name's Jared Allison. I'm a real estate agent with Century 21 Alton Clark here in Florida. Chris Soon, what's going on? You're
Not
also
much,
an
brother.
agent.
Yep, with the same brokerage, just at a different office. Jared's out of New Smyrna. I'm out of the Central Florida. So get the East Coast, and I got the Central.
That's right. So man, so we're gonna try to keep this one moving because I'm so used to doing our long form
And having a glass of whiskey in hand.
and having a glass of whiskey with it, and we go off on these tangents just like I'm doing now. But let's jump back to what we're going to talk about is interest rates. Yep. Interest rates are an important factor when it comes to buying a home. And let's talk about where the interest rates have been in the past. Chris, you've been helping people buy a lot of homes this past year. What have you seen this past year?
This past year, the interest rates have been absolutely remarkable, especially for the year 2021. A lot of people did refis just because the normal interest rate was around 3, 4, and they did down as low as 2s. So historically, we've seen just interest rates just drop, and we'll show you that what that looks like. And then now, the Fed into the new year has already announced that they're going to increase interest rates just to, they kind of have to combat inflation somehow.
Yeah.
So that's what they're going to do. And they've already have announced that it might start in March. So we'll see how that goes. They're going to actually move the benchmark. But even though they are stating that they're starting in March, but we're seeing interest rates now, like they're talking about the benchmark of it all. And then it just fluctuates from there. Correct. So as of right now, interest rates are actually in I think the mid 3s. Right now.
Yeah, right about 3.5% on the 30-year loan. So let's look at this chart here that I have pulled up, and let's see where they've been actually in the past. You should be able to see this if you're watching us live. If you're listening to us, I'm going to tell you what some of these interest rates are. But this chart that I have on the screen, it actually dates all the way back to 1971, where they were right in the 7.5% range. If we move over to 1981 and I haven't done a whole lot of studying on why they went up. I'm sure there was a lot going on. But they peaked out in 1981 about 18.4%. Now, I cannot imagine paying for getting a mortgage and paying 18% on a home. And some of the research that I've done, I've actually seen, so back in those days, higher down payments were actually given compared to what they are today. I think the average down payment right now for 2021 was about 13%, and I want to say it was about 20% back in the 1980s.
So people had money, people had savings back then. Today's day and age, people don't have savings. So a lot of people are check to check, unfortunately. So I'm surprised even right now down payments is that high at 13%. I didn't know that.
Yeah, that was what the NAR, there's a infographic. I don't have it pulled up here, but there's an infographic that has some of these stats. And for 2021, the average down payment was about 13% right now.
Damn. So the NAR is, just for everyone listening, is the National Association of Realtors.
Yes.
Okay.
Or NAR.
NAR, as we usually call it. NAR. NAR, we sound like a pirate now.
Yes. Let's see. So 1981, they were like 18.4%. Let's move over to 2000. So let's look at mid 2000s, in April of 2000. Right. Those were 8.2%. And this is when I'm referencing these, I'm talking about the 30-year fixed mortgage rate. The 15-year was 7.83. And then, so if we jump forward a little bit, get into, what do you think, Chris? 07?
Let's go to the crash. Let's go to the crash. At the height of the market, when it crashed, it looked like 2008, July or October.
Yeah, so let's look at July 2008. So 30-year fix was 6.35, 15-year was 5.92, and then they had 5/1 ARMs at that time at 5.78%. So, I mean, where are we at right now? We're at, well, let me look at the chart here. So last year, we were seeing numbers in the 2 point, under the sub threes, right?
Under. Yeah, it was sub
2.9.
threes.
Yeah, 15
So
years we were seeing 2.2,
yeah,
5-1 on 2.52.
I just had a client close at 2.65, and that was earlier this month. So he had to buy it for the most part. Actually, no, he shopped, and another company was offering it, and then the current company that he was with went ahead and matched it. So
Okay.
2.65 was amazing,
That's
and so that was this
and
month.
that
He
was this
closed
month.
this month, January. All right,
Now what was
so
this, a 30 year or a
this was a
15?
30 year. This was a 30 year.
Holy cow.
Yeah. So
2.6. I didn't know that
yeah,
you could still get a 2.65. Now that he must
he
have had a
he
really good credit score or a really good down payment, or did he buy
no,
down that interest rate?
no, so he actually shopped. He
Okay.
shopped, and a company was offering it. He got a fee sheet, and he presented it to the lender that we were
Yeah.
working with, and he took it to corporate, and they matched it because he pretty much
Wow.
he it was like wow. I looked over at him and I was just like, you are one lucky son of a gun, dude. That's amazing. We just refied, my wife and I just refied the house, and we got a 2.99. So, and it's just
Wow.
like,
Okay.
wow, dude. The fact that you got that is amazing. So,
And so right now the interest rates, I mean, if I look
are
at them
are
right now,
what 3.5, right?
three point five
Look at
five on
that
a 30-year fix. So he's got almost a whole entire point knocked
percent.
off by just
Yeah,
by shopping around.
just by shopping around.
That's crazy.
Yeah.
So
Usually to
um
get a whole point like that, you're spending thousands of dollars
yes.
for a
Oh
point,
yeah. Yeah,
even for a
so
quarter of
basically
a
what you're
point.
doing is you're paying the lender, or you're paying the broker, or however that works, you're paying them to buy down that interest, which in the long run, so you have to do the math. In the long run, it might save you what you're going to actually pay in interest, but you got to do
Mhm.
the math to figure out where your break even point is and all that kind of stuff.
Exactly.
Um,
If this is like a 5-year home and it costs you, say, $5,000 to reduce the interest rate, it's like how long in time will you be saving on that
right,
interest? Will it
right,
take 6 years and you're only out in
yeah,
5? Well, you lost money. So
right,
interest is
yeah,
very important. Interest rate is very important to calculate, especially knowing how long you intend on living in the home,
yes,
or owning the home. It's a big difference
man. So
between living and owning. Um,
that's
yeah.
huge.
And the reason why we're discussing interest rates so much and why it's so important is because it also tells you how much you can afford. It's very important to know how much you can
Correct.
afford. That's a huge factor into it. So, lenders, we're not lenders or anything. They're the ones that can really deep dive into it, into the scrutiny of it. But so as interest rates continue to climb now, as the
Yeah.
Feds are projecting and stating, that's actually going to lower the purchase power. So you may have been able to afford a $400,000 house. Now you could probably only afford about a $360,000 house because the interest rate dropped like a point, or increased, excuse me, has increased like a
Right.
point or half a point.
Right.
And even
So let
during, it's kind of wild what's going on right now.
yeah. So let's talk about what is the forecast for 2022. So I know that the Feds are looking at raising the rates, and there's a couple different, the big reason is of inflation, right? I mean, I've
Hmm.
read that in several articles that,
Yep.
and I'm not, don't get me wrong, I'm not an economist. I don't know how the finite numbers work behind the scenes, um, but I like to talk intelligently about it and say, well, it's because of inflation.
Yes, absolutely. Yeah. Well, I
Yes.
mean, we've pumped so much money into this economy that it's now inflated because we've just the treasury just pump money into the system. So now it needs to get out of the system. And so and the only way to do that is to increase the interest rate.
Yes. So you mentioned something called the Treasury. So one of the articles, this one's on bank rate, and for those of you watching, I've got it on your screen here, and if you're listening, I'm gonna read it for you. But on this article, it says while the federal funds rate doesn't directly affect mortgage rates, there is a strong correlation between the rate on the 10-year Treasury bonds and the 30-year mortgage. Um, That spread widened in the spring and summer. The typical gap between the 10-year government bond and the 30-year fixed rate mortgage is 1.5 percentage points to 2 percentage points. During the scary early days of COVID-19 pandemic, that spread rose as high as 2.7%, but it's since has returned to normal. So
Mhm.
essentially what they're saying is these 10-year treasury bonds, that's a say that 10
Mhm.
times fast.
Yeah.
It's not a direct correlations, but typically you can follow that treasury bond and sort of predict. If you can
Mhm.
predict where the treasury bonds are going to go, you can sort of predict what the interest rates are
Mhm.
going to do.
Yeah, and so the 10-year bond is a secure investment that's backed by the government. So
Hmm.
essentially, a lot of investors, when the market is volatile, they'll then pull the money out of the stock and invest into the treasury. So the more people that are investing in the treasury bond, into the bond, the 10-year bond, the lower that interest rate is going to go. And then when you have people pulling out of it, the interest rate's going to go up. So
Yep.
what they're going to do is actually just raise the benchmark of it, because
Yes.
you have
Yep.
your threshold, you have your benchmark.
Yep.
So what happens in between that benchmark is what the interest rates that we see reflect on a weekly basis. That how we ever see 2.65, like earlier this month, to now it's 3.5. So it's still in that benchmark. It's just doing this around the benchmark.
Yes.
So the
Yep.
Fed is essentially an article released this morning by the Florida Realtors saying that the Fed is going to increase that benchmark, and it's looking like it's going to happen in March.
Yes.
All right.
Yep. And so continuing on with that, so the feds are the ones that increase or decide to increase. And in 2021 or early last year, they were actually saying that, or it was in 2020, they said, hey, we're going to keep the rates low for several years. 2021, they still hadn't really said, that they were going to raise rates until towards the end of last year is when they started saying, things were starting to change. The market's starting to
Hmm.
change. Inflation's coming up and some other things.
Yeah.
And so the Fed said, uh-oh, we need to. So essentially at a December meeting, the Fed's dramatically sped up its timetable for rate hikes. Earlier in
Hmm.
2021, the Fed had anticipated no increases in 2022. Now it's signaling that 3 moves are likely.
Yeah.
So,
I I feel like they are behind the 8 ball on this. I feel like
yeah,
this they should have seen this coming. I feel like they
yeah.
should have seen this coming,
I
and
feel
they should have
like a lot
acted
of the
sooner.
experts, I feel like a lot of the experts saw this coming,
Hmm.
the economists and financial experts and stuff. But for some reason, yeah, I'm with you. Why didn't they see this coming?
I feel like the Fed just has so much on their plate that it's like one thing at a time. Like they just
Right.
like a conveyor belt. It's like, now we got to talk about this. Now we got to talk about that. And then that inflation hit their desk and like, ooh,
Oh, yes.
oh. So in December's meeting, the hot topic is inflation, which is something that some of the good reporters have been talking about in the early months, or the late months of 21. So,
Right.
and then now the Fed is finally catching up with what a lot of people have been saying.
Right.
So,
So, with all that said, we just saw, the rates hit up to about 3.22 or something. What was it, a couple weeks ago?
mhm,
Um, and then as far as what some of the people are saying, so again, going back to this bank rate article, their chief financial analyst, McBride, he expects the mortgage rates to climb up to 3.75% during 2022. And then he's expecting it to eventually fall back to 3.5% by the end of the year. That's just his prediction. I've read some other ones that they're pretty much similar to that, within a few, like maybe an eighth or a 1/4% of, the same prediction. Um, so they're going to raise.
yeah.
Yeah, but where does that put people who are thinking about buying a house right now? Should they hold off to see what's going to happen with the interest rates, or should they,
Um,
if they're ready, or should they start looking now and maybe move their plans up? Maybe they're not looking until the summer, but they're like, hey, um, interest rates are going to go up. Should I start looking sooner
mhm.
and buy something sooner?
Yeah, if you are a numbers person and you're looking at a home that's like 10 years or more, going to be said, like if you're starting to grow a family or relocate family from a middle school to a high school or vice versa, or not vice versa, but from like an elementary, but you want to switch zoning. That's what a lot of people move is during the summertime because of that, schools
Hmm.
and work. But yeah, if you're looking at 10 years or more, you definitely should kind of maybe move your timeline up a little bit again. But I don't know. The way I kind of see it, the market's going to do its thing, and if you need a home and you're ready to buy a home, go get a home.
I agree. Yep.
Because I do invest in the stock market, and I do it in a terms of like every single month I take a little bit of money and I purchase more.
Right.
So I know that the market's doing this the entire
Correct.
time. Sometimes when I
Correct.
make a purchase, it's going to be high, and sometimes
Hmm.
when I purchase, it's going to be low. But if I just do it consistent, then essentially the variations will all essentially accumulate more money. So over time. So when it comes to like purchasing a house, if you're ready to buy a house, buy a house.
Yes.
But
I couldn't
if you're,
agree 100%. I mean,
yeah,
if the time is right, and I mean, if you can save a few bucks by moving it up a couple of months, do it. But
hmm,
if it's not the right time, if you're not ready, don't do it. Just wait.
yeah, yeah,
Because interest rates. So, and that's the other thing. They are still historically low. Let me put up this
yeah. I
infographic.
mean, knowing the fact that even at the height of the housing market and the crash in 2000, 2008 was what we say it was 8% in 2008.
2008. Let me go back to that. 2008. We'll just do all. I hear some dogs barking.
Yeah, Chewy,
2008, they were like
a six
6%,
percent.
between 5 and 6%.
Yeah. So even then, like if you purchase it now, even at 5%, it's still going to be a hell of a lot better
Yes.
than what it was, and it's
Yep.
still going to be a hell of a lot better than the 80s, and it's going to be a hell of a lot better than the
Correct.
90s. So
Correct.
if you're looking to
Uh,
buy a house within the next year or so, like buy a house. If you're ready to do it, buy a house, be a homeowner.
right. And here's a cool little infographic that I found on keeping current matters. Mortgage rates are projected to rise in 2022, yet still remain historically low. And then they have some projected rates down below from Fannie Mae is expecting and projecting 3.3, Freddie Mac 3.5, MBA 4%, and then the NAR 3.5%. So again, still with the projected rise, still historically low interest rates. I mean, my first interest rate, I think it was almost 5%, and that was in
Hmm.
2014, I believe it was. And right now, I've got a 3.125 interest rate. So, I mean, it's if I were to wait, I'm not going to see that number again anytime soon because
Yeah.
they're gonna start rising. Um,
Yep.
the other
That's the
thing I wanted to
case.
touch on real quick was so when you're thinking about if you need some sort of quick rule of thumb thought process to figure out how the interest rates are going to affect your payments. Um, so I have this mortgage calculator. You can go on Google. I just did a search for mortgage calculators. So essentially, I put in $300,000. Let's say you're looking at a getting a loan for $300,000 at 3.5%. That's a $1,347 monthly payment. That's not including your taxes and fees, so it's going to be a little bit more. Any mortgage insurance, stuff like that. This is just strictly principal and interest. Um, so as the rates go up, so let's put in 3.75, which is what from that article earlier, that's what he was McBride was expecting it to go up to 3.75. So we went from 1347 to 1389. If you for some reason needed to keep that payment at 1347 because maybe you just can't squeeze out, or maybe you're already maxed out on your budget at 1347, essentially we raised the interest rate a 0.25%. We went from 3.5 to 3.75. To get back to that, or to get close to the 1347, we had to drop the loan amount by $10,000,
Hmm.
and that gets you back to 1,343. So essentially, what I'm
Hmm.
saying, long story short, for about a 0.25% change in the interest rate, you have to adjust your loan amount by about $10,000, and that'll
Mm-hmm.
get you close.
Yeah.
So it's not an exact science. I mean, you'd have to actually run the numbers
Mm-hmm.
to figure it out exactly. But
Yeah. And if depending on how much it costs to buy down your interest rate, maybe you can use the $10,000 to buy down the interest rate. But is it going to get you
right,
a 1/4%? In some
right,
cases, some of these like 1/4% can cost us like I saw one example was like $12,000 for a 1/4%, $12,000.
yeah,
When the wife and I bought, we were able to reduce our interest rate from a 3.75 to a 3.25, and it cost us only $2,000.
oh,
So yeah, like
dang,
I had the whole 0.5%.
right,
So and it costs us only like $2,000. But nowadays it's extremely expensive, and honestly, I have no idea why. I
yeah.
don't know how how what dictates the prices of it.
Yeah, I don't know. That's so. I mean, that's something that you'd have to talk to your mortgage broker, your lender. They can give you some insight.
Hmm.
If you don't have one, if you need one, give us a call and we'll point you in the right direction. We've got several that we work with, and so or find one in your area. It's kind of state by state kind of thing too, right? So,
Believe so.
um, but yeah, that pretty much sums up interest rates, I think,
Yeah.
for what it's been in the past, what it's coming up for 2022. Do you have anything else to add to the interest rates?
No, not at this time. I think we've
Yeah.
exhausted the years.
All right. Well, cool. Hey, thanks for joining us on our first episode of Whiskey with an Agent Dram
Dram
Style.
style.
We'll explain what that actually means maybe in another episode or maybe in a long format. One of our live shows, we'll talk about what a dram is because a lot
Yeah.
of people are like, what the heck is
How's
a
a
dram?
dram? Yep.
Um,
Oh, I lost you there.
so,
Still hear you.
yeah, I don't. Okay. Yeah, I don't, my camera cut out for some reason. It
I
must
know.
be getting
Well,
overheated.
anyways, everyone, thanks for joining us today on our
Yes.
first Dram Style. There will be more to come, and let us know if you have a certain topic that you guys want us to discuss and research for you. Happy to help out.
Yep. Yeah. And if you're watching on Facebook, make sure you hit the like button, follow our page. If you're watching
Yep.
on YouTube, subscribe and like it, hit the alert bell so you can get more notifications when we post something new.
Sounds good.
All right.
See you, everyone.
See ya.